Hi, everyone. This is Christine Kopr with Sotheby's Realty in Vancouver, BC, servicing the Metro Vancouver real estate market with your market update for December. We have a guest today. We have a mortgage broker on the show today, Ray Macklem from Nest Mortgages, who's going to talk to us about the jumbo rate cut, what his predictions are for future interest rate cuts or no cuts, and why, and as well as some strategies on how to navigate the economic information that's guiding those insights. So make sure you stay tuned. Now that November has come to an end and we have all the data, and there's been so much that's occurred in the last month, we are doing a deep dive on Vancouver, Vancouver West, Vancouver East, breaking down all the product types, seeing what's happening. And there's definitely some renewed activity, which is showing positive signs for this spring. And of course, we're talking about interest rates as those interest rate announcement, bankruptcies that are happening, and what's going on in the economy, because all of that influences our real estate market. So let's get to it. Every month, I love to go over this particular slide. It gives you a real understanding of what's happening in the real estate market. These are the results for the Greater Vancouver Realtors. This is our board that spans from Whistler to Maple Ridge. This is a high-level overview of what's happening in the marketplace. If you want information that is specific to your market, your product type, please let me know. I'd be happy to do an analysis for you and walk you through exactly what's going on in your marketplace, and so you can make an informed decision for yourself or do some future planning. So November ended up with 2,181 sales. That's down 17% month over month, but not surprising because we're starting to head into the slow time of the year. This is where everyone's focusing on Christmas. So this is very typical, not a concern. And what's fantastic is that we had sales over 2,000, which is a good level to be considering our sales or demand for this year. And in fact, it's another blockbuster 28% increase year over year. So this time last year, our sales are 28% higher. This is really what we want to see because it has been very painfully slow. We had a very short flurry in the spring this year. It basically was a January to March, maybe April market, and then it was basically game over. It slowed down very quickly, and it's been quite quiet, particularly in these months of August and September, as you can see. What we have been facing are sales numbers that are approximately 25% the 10-year average to help you understand where our demand has been this year, and it has been 25% below the 10-year average. So it has been low. And what we are seeing now is this month's sales came in at 13% below the 10-year average. So we're not back into blockbuster high demand territory, but what it's showing is that we're coming out of the depths of a really poor market and coming into something more stable, more balanced, and more healthy. And that demand is starting to show up again, which is fantastic news. With respect to new listings, we had 3,725 new listings come on the market. That's down 32% month over month, so way less than what we saw in October, typical for this time of year, and it's 11% above year over year. So it's 11% higher than last November. Not so bad, but as you know, we have been starting to bring on more inventory, and this has been a phenomenon this year as opposed to last year where things were much, much quieter with respect to available inventory, which we're going to talk about next. With respect to the new listings, only 5% above the 10-year average, so we're not having as many new listings come on for our 10-year trend. And with respect to total listings, we have 13,245 available homes on the MLS for the Real Estate Board of Greater Vancouver, now called the Greater Vancouver Realtors, on November 30th. This is down 9% month over month, up 21% year over year. As I mentioned, we were in a very low year in years prior, which was supporting our prices. And this is up 26% above the 10-year average. So as you can see, this is one of the few times we've actually had that supply and that selection available for buyers. Finally, a time where people aren't necessarily always fighting over a property and, having to have limited conditions in their offers or being under high stress to get the deals done. It's more of a normal real estate market in certain segments, but generally speaking, overall. Now, the number that I like to look at, because it is an indicator of which way prices are heading, it's a very quick look at supply and demand. And this is months of inventory, MOI. Months of inventory is the total total amount of inventory divided by your sales, in the sense that if you had no new inventory and your demand continued to be the same, how fast would you sell through the inventory that you have today? And we're sitting at 6.1. This is up from 5.5 in October. So it's up 11% month over month, but it's also now down 5% year over year with respect to the demand and available supply. Between 4 and 6 months of inventory is considered a balanced market. So you can see we've been in that territory. We were in a buyer's market. So 6 months and above is considered a buyer's market, and a seller's market is 4 months and below. Not enough supply for the amount, the high demand. Buyer's market is there's too much supply for the lower demand, and therefore there's too much supply, softening those prices. October was a very interesting month. It was the third highest selling month of the year. It was the first time in a couple months that we saw some decent activity for our second selling season. So it was very positive. We weren't sure if it was a blip. Looks like it's a bit of a trend coming into November, and we are starting to get those phone calls. We are having more conversations, more buyers out there in the market. So I think we are shaping up to a very strong spring. And part of that has to do with interest rates, which we're going to talk about next. Plus, we have a special guest on today talking about interest rates. So make sure you stay tuned for that. So our months of inventory jumped up a little bit to 6.1 months of inventory, but I think that this could easily be tightened up next spring. Of course, it depends on how much inventory comes on, but it also depends on how much demand has been taking a backseat and now is going to be way more comfortable with today's interest rates and getting into the market. With respect to your benchmark price, we're sitting at 1.172. Basically, we're flat month over month, maybe a slight decrease, and down 1% year over year. So things are holding steady with respect to the overall benchmark price. Now let's take a look at Metro Vancouver detached homes. Sales are up almost 20% year over year. So this is what I'm talking about, why I'm pretty bullish for the spring. Sales are up 20%. The benchmark is sitting at 1.997. Your benchmark is up 1% year over year. It's down 0.3% month over month. So there is still a little bit of softening in that detached market space, depending on which market you're in. But generally speaking, I would say there is some softening in those prices. Attached townhomes, sales are up 43% year over year. Your benchmark is 1.117. Your benchmark price is up 1.8% year over year and up 0.8% month over month. This is definitely the segment, and you're going to see that next as we look at Vancouver West versus Vancouver East, that is seeing some rebounding and price growth. And as evidenced as, you're seeing year over year growth and month over month growth. Attached condo sales are up 28% year over year, and your benchmark is 752,800. Your benchmark price is down 1.2% year over year and down 0.6% month over month. So still some opportunities in that condo segment, but of course, not all segments are created equal. Let's take a look at your Vancouver West and Vancouver East market segments broken down. What does it cost and what's the market doing? November 2024 for Vancouver West detached, you're looking at 3.384. That's down 2.4% year over year, but bouncing up a half a point month over month, basically staying flat. And you're going up from 10.4 to 10.6 months of inventory. However, the key thing to note here is that your inventory has decreased year over year by almost 7%. So it looks like the downward pressure in that market is slowly starting to come down, and we'll see where we end up next year. But point is, it looks like it's a good opportunity for that Vancouver East detached. Vancouver West townhomes, you're looking at 1.519 in November. That's up 6.7, almost 7% year over year and up 4.3% month over month. This is a hot product. Notably also months of inventory sitting at 5, which is balanced. So it's come down to 5 from a buyer's market into a more balanced market year over year, tightening up as well month over month and getting hotter quickly. Vancouver West condos, you're looking at 825,900 for a Vancouver West condo. Price is down 1.3% year over year. So pretty much flat or negligible, and down 0.5% month over month. So this is a marketplace where you're at 7.2 months of inventory. So that inventory is coming up again, up from 6 months of inventory, so it's been sitting in a little bit of that buyer's market, but you can see again, inventory year over year is tightening up. This is why we're starting to feel like we're getting a little bit of a rebound, or maybe the indications of a turning around in the marketplace. Now, Vancouver East detached, you're at 1.862 for a detached property in Vancouver East. That's up 0.% year over year, so really flat year over year and down 1.5% month over month. You're sitting at almost 8 months of inventory, so buyer's market territory, but tightened up slightly from the month of October and is also down 10% year over year. So that inventory is starting to shrink. One word of advice about Vancouver East detached, I would argue that a lot of the supply that is sitting out there that isn't getting sold is not homes that resale buyers are looking for, and is what I would consider fake inventory and overinflating what's happening here. I think there's a lot of lots for sale, homes that you would tear down and build on, people that are hoping that it's going to turn to a multiplex and they're going to get paid exorbitant amounts of money for this particular property, or land assembly. In this space, a livable detached home is definitely north of that $1.8 million mark. And I would say when they come up, they tend to move. So keep that in mind. Some of these numbers are not telling the whole story. Vancouver East townhomes, you're looking at 1.118. That's down 3% month over month, but up 1% year over year. So you had some gains, but we're giving a little bit of that away on the east side. So interesting to note. However, you're sitting at 3.6 months of inventory, up from October. So you're going in that sellers to more of a closer to a balanced market. I'm not too worried about this one, or I'm not worried about any market segment for that matter. However, I do think that this will be a market segment that you could take advantage of. And most Vancouver East townhomes in general, just hard to get, thus reflected by the months of inventory in terms of the amount of inventory and the sales. There's just not a lot of that product available for families. Condos, you're now looking at $692,000 for a benchmark price for a Vancouver East condo. That is down, almost 1% year over year. So basically flat and bouncing up 1% month over month. So that could be that turnaround there. You're sitting at 4.2 months of inventory. So just on the cusp of that seller's market territory. And you can see that's come down 30% year over year in terms of months of inventory. And you see that little rebound here in price. So again, this is why we feel like the spring is shaping up. If you're a buyer sitting on the sidelines, I think now's the time to get serious and start getting into this marketplace to take advantage of this, especially if things like the 50-point interest rate reduction stimulates even more activity that started to show up after the consecutive rate reductions that started since June. We're now at a decrease of 1.75% since the reduction cycle began in June. And most likely there's more to come. Now, of course, if there's more to come, that means that things aren't potentially looking so great in the economy, but Vancouver and the overall Canadian economy have always been in a dichotomy. Having a look at the overall trend, you can see we've been bouncing around at these, peak levels for the last few years, but really haven't come off very much. So we have this base level for our prices. And again, I do reiterate that I think that the spring market is going to be strong. And I think there is consumer confidence right now, but there are some tailwinds that we're going to discuss. And before we get into that, just wanted to mention here, like where we're at today in the sales. As you know, if we sell half of what is newly listed, the new listings that come on, then generally speaking, it's kind of one of my just quick metrics. Our total inventory remains about the same. So December, you can see that it's actually quite strong in terms of sales, not a lot of units listed. This is not surprising because typically people don't come on the market in the winter time. They're preoccupied. They want to wait for a better season and when more of the buyers are focused on being in the marketplace. However, this is going to bode well for just tightening up a little bit of that inventory. And as a selling strategy, if you're thinking about selling, then this is something that you could take advantage of, but make sure you contact me because that might require taking action quickly to leverage less competition before the spring market is super active and everybody else is on the market too. In summary, we see a renewed demand in the real estate market as evidenced by October and November sales and a fairly decent demand so far in December, tightening up some of that available inventory with yesterday's 50 basis point rate cut and already starting to see buyers being more active and more interested in the real estate market. I think we're shaping up for a very good spring, both from the buyer's perspective of having decent inventory. I expect more inventory to come on. And also for sellers, it's definitely a better time, I think, to be on the market coming into the spring market with this more renewed sense of interest. Again, we're still in more balanced market conditions, but it really depends on the product type. If you're looking at a condo downtown, well, there tends to be a lot more of that product available versus livable detached homes on the west side or quality detached on the west side. And then townhomes are super hot. So it really depends, but it's starting to feel like we're coming out of the deep dredges and coming into a more normalized and slightly more positive marketplace. However, we're going to talk about some of those economic fundamentals, which we need to be cognizant of because they could potentially derail or soften some of that positive psychology and metrics that we're seeing in the marketplace. What is going to impact the market though? While I'm optimistic about the spring because I do see the demand, I do see the more interest in the real estate market and the jumbo rate cut that we're going to talk about infiltrating the market, there is returning consumer confidence. You can see here the blue lines represent the people who are thinking it's going to be a good time to make a larger purchase. So you can see there's a bit of a recovery in that psychology, which bodes very well. And it's showing up in the amount of activity out there. Again, we're not suggesting that it's super high activity, but there's just a renewed interest coming back to more normal market conditions. And when there's good property, as I always say, it does sell. However, I'm cautiously optimistic, and we are going to discuss some of the economic factors that you do need to be considering if you're thinking about selling, economic factors that could impact the market psychology and the activity coming into next year. I'm going to introduce my guest that we're going to have today, Ray Macklem from Nest Mortgage. Ray, maybe you can tell my audience a little bit about yourself, like where you're based out of, and then we can get right into those market influencers.
Yeah. I mean, I live in the South Surrey area, but we've got an office downtown. Been doing this for about 17 years, background in economics, and yeah, really enjoy digging into the data here as it appears you do as well.
Yeah, awesome. Well, no wonder. I love all your info and love your insights on the economy. Okay, interest rates. Well, there was a big announcement yesterday. Why don't you tell us all about that?
Yeah, so I mean, second in a row of the jumbo rate cuts of the 50 basis point or 0.5% variety. So I think the big thing there was it takes the Bank of Canada to the top end of neutral. And that was something I talked about in November was I think there's a desire to get there to out of restrictive territory. We just don't need to be there anymore with inflation in line and has been since the summer in large part with GDP evolving the way it is and underwhelming. There just was no reason to be in restrictive territory. So making that move to bring it into neutral, I think was the big goal there for the Bank of Canada.
And so noted it was the second, jumbo cut, the 50 basis point cut. One thing I noticed, obviously there's a difference between the overnight rate, which is the Bank of Canada rate, not to be confused with the bank prime rate, which, involves mortgages. But what I thought was really interesting, maybe if you just quickly comment on, is variable rate borrowers now align with the best fixed rates in the market. Is that about right?
Yeah. With prime now hitting that 5.45, a lot of people that are in variable rate mortgages right now are in and around that prime -8, probably to prime -1.25, even from a couple of years ago or a few years ago. So that puts you into that low to mid 4% range, which is roughly where the best 3-5 year fixed rates are sitting right now. So that gap, obviously fixed rates move in advance, right? They anticipate, and they've made their moves over the last period of time, and now variables close the gap on those and likely anticipating a few more cuts here to bring them below current fixed rates.
And so just in summary, what are you seeing these days for fixed and then variable?
Yeah. So on the insured side, we're still seeing prime -1%. On the uninsured side, conventional, a little bit of a clawback there. So we're in the prime -60%, 0.6% range. Fixed rates, low to mid fours, anywhere from 4.19 to 4.49 in that range. So depending on the type of transaction. So yeah, it's gotten a lot better. It's improved affordability.
Yeah, absolutely. And so as we were talking about fixed rates, that's obviously different than the variable rate. And I always like to throw this one in here. It's amazing that just a couple of weeks ago, when I was actually setting one of my commercial mortgages, stabbed me in the eye. Of course, we were up at like in the 3.3s, and that wasn't even the 5-year CMB, the Canada mortgage bond, but here we are, the 5-year bond. And we can see this volatility here, but this is what sets the fixed rates. Interesting note that I've heard or people have been saying and maybe feeling as well is, do you feel that the fixed rate market has kind of hit its bottom of where it's going to be for a while?
Probably, but it also depends, right? I mean, you can see how volatile that's been, and even going back to end of November, beginning of December, before that last inflation print came out, when those numbers bumped up a little bit, you saw a little bit of a surge in the bond yield, right? Which was reflecting the anticipation that maybe the Bank of Canada wouldn't cut rates any further. Then we got the labor market report and GDP, and now it's fallen off again. And this has been how it's been for the last 12 months, right? Like one piece of data comes out and they're like, oh, it's not going to get cut. Then another one comes out. So this market is really projecting an endpoint of the Bank of Canada that's about 0.5% to 0.75% lower than we are today. The only way this will change is if the Bank of Canada deviates from that, right? So if we are in fact in a recession or go deeper into recession, the Bank of Canada has to go lower. Only then will that market adjust and those fixed rates go lower. And I think there's actually a pretty good chance of it.
Yeah, well, that's coming up to the next slides and some of the things that you wrote about. Interest rates, where are they going? And you're expecting a 0.5 point to a 1.25 point by the end of 2025.
I think what the big noticeable difference from this last announcement and the one in October was the Bank of Canada in October basically said, hey, like more rate cuts are coming. We're just not sure of the pace. From here, they've changed it to what you see on the screen there, right? They're going to evaluate the need for further rate reductions, one decision at a time. Now, I think, as I say, that reflects more the uncertainty with what's happening, right? Whether it's the tariff implications and the tax and the retaliation by Canada and the GST holiday, as well as the impending immigration sort of cutoff. So with this announcement, I think the Bank of Canada, they brought it to neutral, right? So they've given themselves the runway to make decisions one meeting at a time. However, I do think that there is enough negative out there. We talk about that range from 0.5% to 1.25%. It really depends on who you ask. Obviously, the more aggressive ones will say we're going to end 1.25% lower. As things unfold, I think the decisions will really be dictated by the data that comes out at the time and how all these different factors interplay and express themselves in economic data. I do tend to think there's a little bit more negativity under the hood that will necessitate further rate cuts, but obviously it is very much a wait and see approach, and being at neutral, they can afford to take that.
Right. That makes sense. And that neutral rate is the rate that the Bank of Canada feels that it's not being restrictive on the economy and businesses to invest and people to get out there and start spending, right? Because they're no longer so much afraid of inflation and perhaps disinflation, which is kind of leading up to the next slide in terms of, why do we think that there could be these future rate cuts?
One of the biggest factors as to why the economy is representing the numbers, right? GDP is positive, consumption is positive. A lot of that has to do with population growth and really fiscal policy. So unemployment being at 6.8% is kind of gross, right? I mean, that's the highest it's been in a very long time. And the only reason it's that low is that the public sector, right, whether federal and provincial governments have gone on a hiring spree over the last 5 years. 45% of new jobs created by government.
Yeah, it's crazy.
And it's not representative of the economy as a whole, right? When you're talking almost half the jobs created, that is not proportional. The government isn't half the economy by any stretch. And so it really becomes a big swing, I think. And they're using effectively tax dollars to create growth through hiring. And I'm not a political person, so let's not make this about politics. It's just a policy thing. But at the end of the day, you don't have to Google too far now to see articles by the CBC talking about how layoffs are coming for public servants. And that is not something that happens very often.
Yeah. Well, it's interesting. I mean, it's a real good opportunity to really think about this upcoming federal election and what to see coming out of this country. I mean, I've listed all the taxes that have been created since 2015. It fills more than one screen. I just don't think we can tax ourselves, into economic prosperity. So that's just my personal opinion.
The line I use with people is I feel like these governments have never met a problem they can't tax.
Absolutely.
It's just not productive all the time.
Well, what's so interesting is in the real estate market, as I just walked through, actually the thing is it's looking positive. Like we're seeing that activity. And I actually think it can be a very positive spring. And funny enough is I've been real estate investing since the 2000s. And it was always a classic. The economy is faltering and we need to lower interest rates because of everything outside of basically the real estate sector. But the problem is as you reduce those interest rates, it creates that demand for real estate. And so this is why I'm bullish on the spring market, because I think that a lot of people have been sitting out waiting to get into the marketplace. They want to own their homes. They want to be protected because, of course, when you're a renter, you have no control over when the landlord wants to either move in or sell that property unless you're in a purpose-built rental. So who doesn't want to secure that roof over their heads? And they've been waiting, and it's been far too expensive with interest rates, having to make up for all the excess spending that the government did over the last few years. So here we are today, but these are the risks that I want to caution or bring to the attention of my audience, just to let them know, like, hey, while there is this positivity, there are these other factors that we have to pay attention to. And these are them, like unemployment, as you mentioned, being at 6.8%. The majority of the jobs created, in the last 5 years being mainly, government related, like that's not really actually truly bringing prosperity and real economic development to our country. Labor productivity is negative, and GDP actually missed the 1.5% forecast. So that's obviously not positive for what's coming in the future. However, you may be in a job sector that may not be as impacted by what's happening in the economy. Although I would argue, like when there's a recession, it tends to influence all, but you never know. I mean, Vancouver and BC real estate has always been this like enigma.
It really is, right? It sort of defies logic. I think you talk about the public sector stuff, and I think that's a critical piece of this. Is it becomes a bit of a smokescreen, right? When you look at labor productivity, I mean, GDP is basically a function of how much people are producing and how many people are producing it, right? And when our labor productivity is negative, the only thing that keeps GDP positive is massive population growth. And that's been given a lot of press lately because we're about to see negative population growth for the next 2 years. So if we have that combined with negative productivity, it's really going to expose the recessionary period that we likely are in because
we've had negative growth for the X amount of months. I mean, we're technically in a recession. I know that we are tight on time here. So just a quick question before I let you go. If somebody is thinking about getting into the market right now or has a renewal coming up, given the fact that there could be these future decreases, like do you go variable or fixed? And I know everyone says you can't really answer that question, but like what's a strategy you might want to offer?
Yeah, the way I view that is really just analysis of risk, right? And right now with prime having dropped to 5.45% and you're taking between 0.6 and 1% off of it, you're a lot closer to those fixed rates, right? I think the fixed rate decision was a little bit more obvious for some people when the gap was wide, but now that we've seen these rate increases, and let's be clear, like the Bank of Canada is not going to go from a 0.5 point rate cut to nothing, right? They don't say, hey, we need a jumbo rate cut, but now we're there, right? That's just not a practical solution, right? So the tonal shift, I think, reflects more the uncertainty, and they don't want to lay the groundwork and have people expect. But when it comes to that, yeah, I do think there's some upside to the variable product, because if we are in this recession, if some of these factors become more pronounced as time goes on, and generally they do, the likelihood of rates dropping further becomes larger. And in that case, we're already refinancing people out of 3-year fixed rates that we did 12 months ago, right? And the same fears existed then. Well, what happens? And now we're seeing that play out in real time with the expectation of more rate cuts. And so it becomes a risk thing. And what we do is we really put that into numbers for people and look at the projected rate cuts and how that's going to impact your savings. And it really gives people a good idea of where they stand, right? When you can express the magnitude of the risk, it's going to be $3,000 worth of savings or $5,000 negative, whatever that case might be. It really gives people confidence to make those decisions and look at it from their point of view.
If any of my audience wants to contact you, how do they do that?
Yeah, you find me on Instagram, Ray at Nest Mortgage, nestmortgage.co, and yeah, I'd be happy to connect.
And that's Nest, N-E-S-T.
Nest, correct.
Yeah. Okay, yes. Awesome. Thank you so much for joining us today. Really look forward to doing this again sometime.
Sounds great. Look forward to it.
Cheers.
Thanks, Christine.
Bye. Okay, well, there you had it. There's an update on the interest rate market, but also coming back to the things that will influence the future. And we're going to go into some more specific influences. So as you can see, we've already listed off some of the reasons why they could be future rate cuts. There's also the construction sector, which is a large part of our economy. There are potential job losses coming into that sector when that finally winds down, because there is a decline in the pipeline of new projects. Construction sector risk. Here we have 9% of Canadians work in the construction sector. We are in a record condo construction right now at all-time highs. However, the pipeline for new projects that are coming online as these projects complete, imagine the building is built, those guys are all done. Where does that entire crew go? They need to have another project coming into the pipeline to keep all of their staff employed. And what's happening is that is coming to a complete stop. You can see here, this is speaking of the GTA, the Greater Toronto Area, which has a huge pre-sale, pre-construction market. You can see 2024, these are the started construction projects, not yet started, and how many are coming down the pipeline. And there is like nothing coming down the pipeline. It's actually pretty scary to see what's happening. And while that can make the current marketplace a little bit unknown, a little bit of fear what's going to happen in prices, and there's probably going to be some more softening in prices, there is going to be that halt where developers go, hey, this doesn't make sense anymore, and then they don't build. And then the thing that you really need to think about is, well, what happens in 5 to 10 years when all of a sudden there are no more projects and there is no more new construction coming online? And then we end up right back to where we were, which is a housing shortage, especially if our population continues to grow, albeit more moderate levels. So this is what makes this whole thing so cyclical. Things get out of hand, things get pulled back, and then we end up in a shortage again. And then there's that support for prices in the future. So if you can ride it out or maybe take advantage of some of the current softness, perhaps in this particular market, a little bit in Vancouver, but not as much, maybe some opportunities in those pre-construction markets, not as much in the resale market that we're feeling at this point in time. Anyhow, those are some opportunities. And you can see that Vancouver is not the only market that is immune. Here you can see Thind, their project has been placed under receivership. That's an $85 million debt. Even in this particular instance, this property is 90% sold. They had another project that just came online that went into receivership. You can see Westbank, a prominent Vancouver developer, is being sued by Graham Construction for $2.8 million. They've had some money outstanding. There's been numerous articles coming out about Westbank having some financial hardship, and you'll see also they've been on a bit of a selling spree, probably liquidating some of their assets to top up their cash just to deal with, all of the projects they have on the go and the slowing sales. Like think Oak Ridge, think major projects like the Butterfly coming to completion and other massive projects that they've had. Kengo Kuma still has some units for sale. And then there are other major projects over on the East Coast and down in the US. Here's actually a unique example where Curve, this is a pre-sale project, they are now going after unpaid deposits, 4 units totaling 4 million, 5.3, and 5 to 16.7 million. It's about $21 million in total for deposits that are to be paid. And it's actually all one family office that they're going after. So that's a lot of money that those guys are missing from their buyers who may or may not want to proceed with their pre-sale contracts, or perhaps those buyers are having liquidity risk somewhere else. And then you can even see here, there's other issues going on. And this is more of a contention between two development partners, but another site in Burnaby, a massive 14 building project, is going into creditor protection. There are headwinds happening in our construction center to bring on new development, new homes onto the market. Now, I know there's a part of the audience out there that is okay without more strata coming onto the market and really looking forward to all that multiplex, etc. You can see the challenges that are being faced in the construction sector. There are other economic challenges, for example, disinflation, because inflation has been the main target of the Bank of Canada. They want to make sure it is toned down. However, it is toned down at 1%, which was the latest news that just came out. But the majority is driven by interest rate sensitive goods like mortgage costs. And even that still remains high. So if your mortgage costs are high, but your GDP number is coming in at 1%, having that part of your GDP still remaining high means that the rest of the economy is doing really, really poorly, being masked by these rate sensitive parts of GDP. So we also have these recession indicators that GDP per capita has declined for the last 6 consecutive quarters. And even our past Bank of Canada Governor Paulos said it's not a vibe session. This is a real recession that's happening on the street and has been masked by some of these other policies occurring, for example, government hiring and extreme immigration policies, which have now finally coming to a grinding halt, which means that demand is going to soften quite quickly in the future, and therefore limiting the demand for potentially for housing and other goods like medical services, etc. And just coming back here, we have the housing starts and the construction looking very bleak. Here's some information in the news, just that there's just not a lot of people interested in buying these pre-sales. Number one, they're expensive. Number two, people have fears and that the numbers don't make sense. So what is the government doing in order to help? Well, we've got government intervention. I forgot to finish this slide. So, you've seen things like these jumbo mortgages, for example, insured mortgage price increased up to 1.5 million up until December 15th. Right now, if you're a first-time home buyer and you want to put less than 20% down, you can only do that on a purchase price of 1 million or below. But as of December 15th, you'll be able to purchase up to $1.5 million with less than 20% down. There's also the 30-year amortizations that was allowed. First, it started off with first-time home buyers and now also includes new build buyers as well. So you don't have to be a first-time home buyer to have a 30-year amortization, which means you get to spread out your mortgage over a longer period, thereby reducing your mortgage payments, making it more affordable. And they just recently announced, I think they're going to be offering even more money if you want to finance a suite into your home. They're allowing you to refinance your mortgage in order to raise, I think they're going to give you $80,000 to put a secondary suite into your property. So the government is really trying hard to implement policy that is going to stimulate and create more housing because they can see the writing on the wall that it's just not going to come. While it may sound like they're doing something to help create more housing, for example, the Federal Housing Accelerator Fund, it's not always as good as everybody thinks. Burnaby approved all the density. However, they received $43 million from the Housing Accelerator Fund. However, they turned around and raised development fees for high-rise new strata construction by $50,000 per unit. That might sound like a money grab, but the fact is if you're going to do the severe, intense densification, the infrastructure needs to be there. You can't add all these people without the sewer, without the water, etc. And somebody needs to pay for that. And it's going to be paid for by the people who are buying these new properties as new fees tacked onto the price of those homes, and in fact is making them more expensive. There could be different ways of dealing with this, spreading out the cost, but for now, this is what has happened. So in the high-rise world, they've added $50,000 per unit, and in multiplex, they're adding nearly $100,000 per door. So if all of a sudden you can build a fourplex on your lot, they need $100,000 per door, which doesn't make it economically feasible. It sounds great that everybody can actually build a fourplex on their lot. Now it's legislated by the government. It doesn't always make financial sense. Even in the city of Vancouver, you have to update the sewer to the nearest sewer line for your entire block, so to speak, if that's how far you have to go. That adds a significant amount of cost to the build. So not every lot is going to be great for multiplex development. And while there is zoned in density, it will not necessarily transpire if it doesn't make financial sense. Keep that in mind while the government tells you that they're going to build new housing because they have this housing, like in the federal government, they're going to give out all this money for infrastructure. Well, the cities have to play ball as well, and they will get that money, but they want more because they probably have so much infrastructure that needs to be upgraded. Or it was a loophole in the policies and it was an oops. And now the cities can get the money based on the current legislation, but they don't have to play ball when it comes to other aspects of the legislation when it comes down to the municipal level. It's the same thing with our provincial government zoning in the multiplex. While it is zoned in, it doesn't mean that it will necessarily be practical or financially feasible or economically make any sense on every single lot. So you're probably not going to see all that extra housing that everybody's talking about, but it does put a bit of scarcity on our single family lots. They're not making more of those. We see a real desire for people to own those single family detached lots, especially because when it does make sense and this infrastructure does come, they will be torn down eventually, and the multiplex and the density will come. So one of the other things to talk about too, some new news that's come out in terms of the mortgage renewal cliff. 2025 has the highest amount of mortgages that are being reset since, the emergency low rates below 2%. But some stats came out, or information came out from CIBC saying 40% of mortgages renewing in 2025 will actually see lower monthly payments based on what rates they secured at the time. 10% are going to see an increase of less than 10%, and the remaining 50% will face on average a 20% payment shock. But that's manageable given where wages and home price growth has gone over the last 5 years. So perhaps not the big scare that everybody was thinking was going to happen in the marketplace. So with all of this, we're actually starting to see a continuation in decline in rental rates. You can see this is for one bed furnished is down 0.31%. Average one bedroom unfurnished is down almost 3%. And you can see last year's previous rents, what they are this year. This time of year is one of the lowest times of year. It's the slow season. It's where you get the weakest rates. And it's also the best time to be purchasing homes because there's not as much interest at this time of year when you're thinking about getting into the market. So you can see that there is just some more affordability on this side of things. So renters can rejoice. For investors, obviously, it makes it harder and harder to provide rental housing because, as you are aware, the majority of housing is provided by mom and pop investors, sometimes labeled as those evil investors or speculators in the marketplace, but they're truly the ones that create the majority of the housing, whether it's by their basement suites in their homes or being the ones who are those pre-sale buyers, investors who risk putting their down payments, hopefully making it through the market cycle and bringing condos to market, which people will eventually rent if they're not in a position to purchase yet. Without those people, we do not have home construction unless it's purpose-built rental, which we finally have had showing up into the world. But that's also challenging, and we're seeing some of those projects actually being shelved just because of rental increases being lowered, and of course, like sub what inflation is, and while property taxes and insurance and all the costs to actually operate those properties, the expenses have increased far beyond what the rental rates are. And most people who are providing rental housing, if they're not a non-for-profit and they're just an individual, they cannot subsidize those negative shortfalls to maintain and own those properties. So therefore, you don't see those people coming to the market and not participating in providing future rental housing. And therefore, we have a little bit of relief on the rental side of things in terms of rental rates, which is great for renters from that perspective, not so great for creating more rental housing to help bring those rates down more permanently over the long term. What other, factors are out there? Well, there's inventory. We are seeing inventory come on. We have had more supply of inventory, which is fantastic. Again, more options, bringing us more into a balanced territory. But I do want to reiterate, we are not in any kind of extreme market conditions at this point in time. And in fact, we're starting to see a bit of a recovery from last year in terms of market activity and this very soft activity we've been experiencing this year. And looking back, this was the last time, 2019, I remember it was a very slow market. We've actually performed better than that and well below coming out of 2014, 2015 after the great financial crisis. And you can see that inventory currently is tightening up, which is typical for this time of year. With that, I hope you've enjoyed this market update. It is jam-packed with so much that's occurred in the real estate market. We are going to try to break that up into certain segments. And if you have any questions about the real estate market or you want an opinion about your particular situation, I welcome the opportunity. Please call, text, email, and we can schedule a time to discuss your situation. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. I appreciate your time. Make sure you like and subscribe and sign up for my newsletter so you get this straight into your inbox, and I look forward to seeing you next time.